Welcome to the Minds Capital Podcast, the show devoted to the growing world of independent sponsors and entrepreneurial private equity. I'm Will Smith, here with my partners in Minds Capital, Max Lummis and Nicholas James. Today's conversation is with Chris Breaux of Emberline. Nicholas, Chris was just in St. Pete, and you guys had a chance to catch up, right?
Yeah, that's right. So a week or two after we recorded the interview, he sent me an email and said he's coming through town. He was going to meet with a business owner, I think, on a prospective deal, and he was wondering if we could grab coffee. So that was a lot of fun. It was an afternoon. I set it up so that we would do a little bit of a walk, and I could show him around. And so that's what I did. He was dressed for business meetings and not walking around in the sun on a hot Florida day. So we eventually found our way into a coffee shop, and Chris is he's a little bit of a coffee connoisseur, I learned, and I think he was happy with the choice. He ordered an espresso. I always think it's funny how the people who love coffee the most order the smallest coffees. But anyway, we had a great time, and Chris, he talks very fast, and he has to do so because he has a lot of smart stuff to say. This is one very intelligent and well-read person, and we were lucky to have him on the podcast. I was lucky to spend some time with him, and I'm excited for this episode to go live. One thing that struck me, and we talked more about it over our coffee as well, is he made the point that it's easier to attract talent and hire top-notch recruits at the fund level, or meaning at the independent sponsor level, as opposed to within any given portfolio company. And so this really makes sense, right? If you have 3 or 4 holdings and you are trying to hire someone for your training business or HVAC business or manufacturing company, it can be hard in small business America to attract the best talent. It's also hard to rationalize the big cost of strong talent when you're a small business. However, if you can go to someone and say, hey, you can solve problems within your domain of expertise across 3 or 4 portfolio companies, and these 4 portfolio companies can split the cost of this resource, then it's easier to rationalize the cost. It's easier to attract better talent. And so I thought that was a smart way to strategically build a team and also augment each of his portfolio companies that may not need an expert full-time, but can really benefit from having an in-house resource, so to speak. And the specific use case that he was talking about, which we, I think, discussed also on the podcast, is they're in the market looking for an applied AI implementation expert. So this is effectively someone who works to improve AI usage and workflows and utilization inside of operations, which is something we all are dabbling with and wondering about these days. And so Chris and his partner are taking the extraordinary step here, at least within the independent sponsor world, of recruiting someone in that capability in order to have an edge on the technology side and really take things to the next level. And I have to imagine that's helpful not only for their current portfolio companies, but it would be a really powerful pitch to business owners as they pitch new deals and are sourcing new deals, if they can say that we have this centralized team and these kind of resources that can help take your business to the next level. So yeah, lots of great impressions, and very smart guy.
Yeah, Nicholas, your point, or Chris's idea about having the portfolio level AI specialist, I feel like we're going to start to see a lot of that. It actually kind of reminds me of the late 90s when there were so-called webmasters, which is a title you still see every now and then. But I remember it fondly. And you talk about the webmaster at a company, and it was the person in charge of the website. We're in the webmaster days of AI roles, but obviously we're going to see that blossom here over the next 5 and 10 years. On the point of technology, what I liked about our conversation with Chris was being able to hear directly from a owner, practitioner of lower middle market software adjacent businesses. So the business press has been filled for the last 2 months with the fear, the opportunity of the commoditization of software. Is B2B software going to zero as vibe coding and all these Claude Code and the rest are really putting a giant question mark over the business of software, which has been one of the most coveted, admired business models of the last 10 and 15 years. So very obviously, we're all seeing those headlines. So just really interesting to hear from Chris, who's at the front lines of that, respond to that and actually be affected by it in his own portfolio. So that was kind of my favorite piece. Max, what did you think?
Well, I think you guys have already hit the main points right on the head. It's super interesting to hear how SaaS has changed so quickly and how, like you said, Will, a coveted industry is sort of in question right now. Just a few years ago, SaaS businesses were obviously super attractive and had high multiples and recurring revenue that you could count on because the switching costs were just so high. And the moat for these software businesses was their code. And so all of a sudden, code is not a moat anymore. And so, what are these companies now worth? That's been a little in flux lately. So it's just an ever-changing dynamic here with technology. And we're just kind of at an inflection point here with AI. In regards to the applied AI engineer role, I agree. I think that applies to every company. That's something that we should all be thinking about. That could even be a company in and of itself, just applied AI engineer consultants that help companies implement and pick the right software and the right AI to improve workflows and to improve businesses. None of us can keep up with that. So I think as we think about the disruption from AI and job losses, it's really going to be interesting that there are going to be jobs created. And I think this applied AI engineer or applied AI engineer consultant job is one of those jobs that we would never have imagined just a few years ago.
Yeah. Interesting times. Well, before we get to the interview, a reminder that at Minds Capital, we invest equity into independent sponsor-led acquisitions. Our check size is $1 to $3 million per investment. We average about a commitment a month. So if you're a sponsor raising equity for a platform acquisition, submit your deal to us via the website mindscapital.co. Or if you're interested in investing in Minds Capital as an LP, there's a pre-registration form on our website as well for accredited investors. If you're an accredited investor, fill that form out to be kept in the loop on future raises, mindscapital.co. And here is the Minds Capital podcast interview with Chris Breaux of Emberline. Enjoy. Welcome to the Minds Capital podcast, your connection to the growing world of independent sponsors and entrepreneurial private equity. We are your hosts, Will Smith and Nicholas James. Before founding Emberline in 2021, DC-based Chris Breaux was an investment banker used to working on $500 million plus transactions. As he'll tell you, coming down to the lower middle market was a process of readjusting to the scale of sub $20 million deals. Emberline just closed its third acquisition a few weeks ago, and they're in the process of building a portfolio at the intersection of government, vertical tech, and growth. So they invest in growthy businesses. Chris Breaux, welcome to the Minds Capital podcast.
Thanks, Will. Excited to be here.
Chris, let's hear more about your transition into this world. You had told us that you were naive when you got into the lower middle market. Tell us more about this naivete and what you discovered down here as a first-time sponsor.
Yeah, of course. It's always hard to kind of hear that and, confront that, but it was. I mean, I was, in my IB days, I enjoyed it very much. We got to do, lots of variety of transactions. But I really didn't appreciate and understand really the types of companies and people I was interacting with and working with. I was an engineer before going into IB, and that itch always was there. And walking away and building Emberline was a huge interest and passion that I've always had, but I didn't really understand what I was getting into, which I suppose is probably the same story for every entrepreneur. So there's nothing new there. But for us, it was, and me and my partner, it was really around learning how to kind of reorient ourselves around all the challenges that come with middle market and lower middle market. A lot of the fundamentals and pieces that are in place at larger companies just aren't there yet. And so, it's a double-edged sword. You can have a lot of impact, and I think we've discovered and really started to appreciate how much you can really help the businesses, when you're investing at this size of the market. But at the same time, all the kind of core fundamentals, the basic processes, the things you need that you expected to be there when I was doing and working with senior executive teams and much larger transactions, larger businesses, just aren't there. And so it really takes a reorientation, jumping down. And that was hard for us, learning those pieces and getting through those learning curves.
So the motion of what you guys basically were going to be doing at Emberline was of a very different nature. You were going to really be professionalizing businesses, and you probably thought you were going to be transacting businesses more.
Yeah, I mean, I would say it was. I'd say I was an engineer by training early on, and so I think one of the reasons I left IB is I wanted to be more in the building side of things, and get away from more the transaction oriented side of it. But I just didn't understand what it was like. The resources, the capabilities, the teams, the orientations, the classic cliche people, process, and product. And I break that up. It's all those things matter, and they matter with the large businesses too, but the types of challenges you go through each one of those, and we can dive in, it really is different. And so it took us a while to really fundamentally understand what's going on. And we walked into our first transaction, for example, a really great business. We spent a long time in the market. We thought we were doing all the right DD, and we missed a few things, really around kind of what it would take to actually scale the business. And I think it could be a function too of our orientation towards growth as well, where you need to go slow to go fast. I think we learned that the hard way in our first business, where we wanted to come in and really help the team grow. The sellers that partner with us to come in, I mean, we partnered with them, they rolled in, they wanted to grow as well, but we missed a lot of the core pieces around all the fundamentals that needed in place to do that.
Let's get into this story in some detail. So this is your Interra deal, your first deal, right?
Yeah.
Give us kind of the set the table for us on what it looked like, and then let's get into a couple of the themes you just touched on.
Yeah. So Interra is, I mean, it's a pretty unique and remarkable business. It was, we acquired the business. It was our first acquisition in 2021, really around partnering with the founders to help scale it out. We focused heavily on the macro dynamics, which again, looking at large market deals versus small market deals, going into an industry with tailwinds versus headwinds is a material difference. And again, it's software for firefighters and first responders. You've probably been around and seen some of the kind of headlines of the last couple of years. I mean, you've seen smoke, going into the San Francisco Bay to New York City and things like that. It's becoming more and more an issue. It was a great time to kind of go in and help try to partner with, people like the Interra team to really figure out how to scale the business. But at the end of the day, when we got in, we didn't understand the complexities around the tech debt and how to kind of drive that, getting the right people in the right seats. That's the people, product before that, and then getting all the processes in place. We really focused initially on growth, and I think we broke some things. I mean, put the short of it, we were naive about what we needed to do.
What did you break? Give us an example of something that went wrong.
I mean, the simplest way to explain, one of the easy things was our technology. We misunderstood the limitations of the tech stack. So the cliche tech debt, right? It's when you think through how to do it. And I mean, this is something that's shifted massively too over the last 5 years, AI and what's enabling. But even back then, it was in order for us to start to lean in and grow, we had to really appreciate what it takes to have a scalable product. And there were a lot of things that were breaking left and right that we didn't appreciate and understand. And again, we thought we knew we were evaluating tech debt coming in, but we missed it. We really did miss it. And it was not understanding what we needed to do to prepare the platform for new customers, new onboarding, new growth, and all those things.
And so you refactored or rebuilt from scratch?
Yeah, that's a good good point. We did the thing that I would say a lot of PE is, it's kind of anathema, which is we decided after trying to go through and kind of learning our lessons to rebuild. And this is function of what's going on with AI and a little bit of segue into that piece as well. But the calculus is, for software particularly, is shifting massively. And we decided, about a year and a half ago to rebuild the company's tech stack in a really major way. And we started from scratch. When we looked at how do we expand the product, in the systems and what we need to do, the cost to expand kind of an older, I use sometimes the slang term of spaghetti code, which is not so much a fault of the company, but just when you add on for over a decade, plus businesses have been around, you just end up with a lot of conversation or what do you do? And it came to the point where we realized it would be better to start from scratch. And it has fundamentally changed the business. It has also fundamentally changed our view of how to think about software investing, in a pretty material way.
And do tell. So
it's shifted everything from how do you think about tack-ons and acquisitions in software? And again, just for context in the audience, there's always more tension when you're doing software roll-ups because you have to do deeper product integration than maybe you're doing a service business, where you're kind of grabbing customers and taking everyone on your consistent back end. You have to do true product integrations between migrating all the product and the customers. So you in our view, you have to be much more judicious about tack-ons and software. Again, unless you're doing more of a large scale conglomerate. But when you're little middle market where we are, you got to stay as one product. And so when you're doing that, or it leans back towards organic, I would say, code is no longer a moat. You've really changed the dynamic around what it takes to spin things up. And so for us, it's looking harder at organic growth. It's really understanding that you can't sit idle either. There's, the cap intensity's come way down, but the velocity's gone way up. And so you really have to think through and make sure your teams are ready to kind of run faster, because competitors come at you quicker.
It's a big question, but how should people think about investing in B2B software? I mean, just in the last couple of weeks, we're seeing tons of headlines around. I mean, they're just getting battered in the markets. It's been remarkable to see the collapse of demand for software developers. So these B2B SaaS businesses, they are good acquisition opportunities. You wouldn't touch them. I'm sure it depends, but boil the ocean of my question, please.
Yeah, of course. In the short of it is, I think everybody, us included, are being more circumspect. It's nothing. I'm not saying anything insightful here when everyone looks at software and you're constantly worried about getting, disrupted or disintermediated by a lot of the AI tooling that's coming up. There's also a tremendous amount of capital coming in, again, for the large market PE guys from other VCs coming after trying to grab new share. And again, some of that may fade out. But all of the core, especially for an indie sponsor, doing lower middle market deals is, there's this more existential, will this business be around in 5 years that didn't exist 5 years ago?
Right.
And I think it'll sort itself out. A lot of this now is we're in the big kind of moment of unknown. Again, the flip side of that is there's a huge moment of opportunity. I mean, we're seeing that in some of our businesses too, where there's buying cycles are getting compressed and there's openings that happen. Just as people can come at you quicker, you can go at other people quicker. But generally speaking, in B2B software, you got to think really, really hard about what the moat is of the business. Code isn't a moat anymore. It's not knowing you've got a good form fill or workflow doesn't do it. You got to really focus on what is it going to keep this business around.
And Chris, when you rebuilt it in Interra, did you use AI tooling to do that? Or did you use conventional development?
We use a lot of AI, but I would say limitations and ease at which coding becomes easier, the value of the judgment and taste of the team becomes more important, and substantially so. So I think one of the things that's really interesting for, indie sponsor investing, and especially smaller, lower middle market businesses, is you end up partnering with a company and a team that has a very intimate understanding of the customers and the problem. So this very interesting dynamic where you can if you're coming out of YC and trying to do a startup and do product market fit, customer discovery, all those normal things, that gets short circuited to some extent if you work with the team who already knows all of that, right? And is already deep in the mark in the business. Going back to the AI point you made, which is, for us, like, we could rip through user stories, customer journey, create the PRDs, the project required documents to kind of spec out a new build very quickly with AI, but AI just augments what the team already knows and what the team understands. And so it lets you go a lot faster. But the judgment about what to build becomes more important. And that's where you can easily go off track too.
Mm-hmm. So it wasn't all about just AI writing the actual code. It was about all the tools kind of around the process of development and the tribal knowledge that the team had, that kind of working together.
Absolutely. It's and honestly, in an odd way, AI makes it also a little more challenging. When anybody can start coding, everyone starts. The default, and so we see a lot of vibe code, is just start making things. But all of a sudden now, when you can make 20 things in one day, what do you make, right? And so there's this little bit of, you can do a lot, so you really got to focus. Simple is hard, right? That little cliche. Yeah, for sure.
So I think your answer on whether or not to go into B2B software is contingent on the circumstances and the specific target, which makes sense at any given time. But how about for those who entered a few years ago? Obviously, if you had entered the space 10 or 15 years ago, you probably had a good journey. But what about those who entered a few years ago? Where are they right now, typically, based on your observations?
It really, again, like anything in investing, it depends. I think you can't, and again, I maybe have a unique perspective, because before I was doing software, in one of my IB days, I sat in the industrials group, actually, and industrials oftentimes is kind of a catch-all for a lot of different subsectors, in a market. And so I had a perspective around, I worked everything from, aircraft lessors, which is basically a financing business, to, mining, to Midwest manufacturing businesses, and then technology and hardware and software. And the dynamics around software, are unique in the sense that the product evolves faster than other sectors I've been in. And so again, comes back to double-edged sword. You can move faster, but you have to be careful. So investors that came in 5-10 years ago, the requirements and the R&D to move the product forward have gone up. And so if they've been sitting on their laurels, kind of harvesting cash, that can come back to bite them. A lot of people in software like to talk about how the marginal cost of the next user is effectively zero, or I should say SaaS is effectively zero. And that's true. I think what's happened, though, is the near-term marginal cost is zero. The longer-term marginal cost is actually is always there. And with AI, it's gone up, because you need to plow those R&D dollars back into the product to keep those customers in years 2, 3, and 4, because other people will come at you otherwise. So that's the piece where you got to be just for again, going back, people that have been in it for years, if they've been on it, they leverage the talent and the market understanding of the team. You can, being in first mover, first scaler is a big deal, and that matters a lot.
Chris, can you give us a picture of the Emberline portfolio beyond Interra?
Yeah, of course. We've got 3 portfolio companies today. We're, as you highlighted at the beginning, Will, we're very much a growth-oriented investor. We focus on a lot of things that do, involve either directly as government sales or adjacent to government, and technology, really. So, we've got first business, Interra, software for firefighters. Second business is a company called TVX, which is software for aviation mechanics and compliance. And the third business is called P1, and it's actually a services business, does tactical training in the aerospace and defense markets. But it's very tech-enabled, AR, VR dynamics. And for us, it's, it fits the profiles that we love, great niche oriented businesses, dominate their sector, a lot of potential. 2 out of the 3 businesses, we partner with the founders. I think a huge piece for us. Again, not uncommon with other sponsors, but we're a smaller investor compared to the other private equity firms out there. We value and really, really look for high quality partners that we can get aligned with, that want to come in, usually roll, and then help them kind of sprint through the next phase of growth. And that's been our pretty consistent MO too.
There's that government theme, and you're in DC. Is that a coincidence, or is that part of the theme?
Probably not a coincidence. Although I'd say, for me, it does help. We love anything that's kind of longer sales cycle, very sticky, where we can drive the impact there. But having a lot of comfort around going through government hoops, if we have to do a hill tour because we want to push some sort of legislative initiative or just understanding, that's something maybe other sponsors wouldn't be as comfortable with, and we're fine doing. Going through more tricky aerospace defense things, like foreign direct investment issues, or like CFIUS here in the U.S., things like that, we're more comfortable with. There's a lot of approvals and regulatory things that we'll entertain and deal with. I think that maybe some others won't. But it's at the end of the day, our general orientation around kind of growth, government, technology, I think is the same with maybe a lot of other sponsors too.
Mm-hmm. And Chris, can you give us a sense of the portfolio and numbers around it, size of the aggregate revenue or revenue of each of the businesses?
Let me think. Between all three of the businesses, we've probably got 60, 70 employees. We're kind of aggregate, not quite 25 mil of revenue, but we're all growth oriented across the three. I think we should cross that threshold, soon. But for us, it's, again, especially software, you're really pushing, you're pushing top line a lot, that's pretty heavily. Even in the tech-enabled service space, you're really focusing on top line growth. And so we tend to, and again, going back to the earlier point, go slow to go fast, I think is a huge thing that we learned early on. Making sure that you have the right infrastructure and systems, people, and processes to make sure that you're ready to start entertaining growth. And so for us, it's not so much about the revenue base coming in, as long as you can support those kind of early pieces, but making sure you feel like you can move into a TAM that has potential, that has scalability. You get the teams there, and again, we just closed our third deal. Our second one was a year ago, and then in Interra we've been for several years, and Interra now is just starting to hit its stride. It's our most it's fastest growing business of the three.
And so you're all three businesses and sort of your strategy overall, you guys think in terms of ARR, and your businesses would trade against top line?
The software for sure are ARR driven businesses, business service or service-based businesses.
Tech-enabled. Yeah.
Tech-enabled. They're still EBITDA businesses. You can gut check them on revenue, but we still think you have to think in EBITDA.
How is the process of raising equity for a growth investment versus if you're doing a more down the fairway LBO, which is what we more typically see in the independent sponsor space?
Yeah, hard. I would say it's. We learned this with Interra, which was, and again, also the indie sponsor market is developed tremendously in the last 5 years. So it's gotten easier, but the growth oriented investing in the sponsor world, I would say was very challenged a lot, 5 years ago. There's a lot of the existing investors were typically more, EBITDA investors. And it's been, that was a big learning curve for us too, kind of going through and kind of doing the Interra acquisition. It shifted a bit. I think we've seen, in our last deal that we just closed, the amount of new LPs that have come into the space that are actually open to software, open to growth, has been remarkable in the last 12 months. For me at least. And so that's great, but it's still a niche within indie sponsor world, the kind of growthy oriented software investing. A lot of people LPs that do software investing still come at it from a VC standpoint. Though it's smaller check sizes, it's kind of might go to zero check, and so they're a little more kind of careful there. But we are seeing more people shift into software buyouts, or kind of our niche, I would call it buyout growth. But it takes the going to an SBIC, doing a big debt recap. We rarely put debt on any of our businesses, at least to start. And so it has become, it's getting easier. But it is not the same, I'd say, as doing a larger EBITDA-based, manufacturer or service business.
So can you define further and spend a minute defining what is buyout growth, as you said, versus a buyout, or versus growth, or versus VC for that matter? What are the distinctions between these classifications?
Yeah, I mean, you could yell at me for making the term up.
No,
It
I
is
love the term. Yeah.
it's really, I would say, in between kind of growth equity and an traditional buyout, in the sense that we tend to under-lever or no-lever, so over-equitize the business. We're looking more about top-line growth than we are about financials and cash flow, potential for the business. So when you're looking at growth equity deals, you're looking at the TAM expansion. You're looking at really about how much market share can you realistically grab for the next period of time? What does excess cash in the balance sheet do? Can we deploy that capital in a productive way? That's kind of a little more the growthy aspect of things. So when we're doing
What do you mean? So as you accumulate cash on the balance sheet, you're thinking ahead of time, not about dividends or debt repayment, but how can we invest that to continue growth of this asset?
Exactly. So we tend to not, and again, the calculus shifts a bit between SaaS versus service, I would say, just to be clear. But we're looking at the cash that spins off from the businesses, and do you want to reinvest it? The difference between hiring a couple more AEs and SDRs to drive the top line, because SaaS particularly trades on top line, right? Versus kind of harvesting that cash and sending it out to the investors. You're looking at what drives more equity, and when you got top line driven valuations, that the looking at sales efficiencies for the team and the difference between one more AE versus sending that cash out is the dynamic, I think, that shifts between growth versus your typical more cash flow investing. Again, not to say that when you're doing a typical roll up that doesn't matter. There's other ways to deploy through growth, roll ups, right? For example, where you're taking that cash and relevering up through a multiple R. But for us, again, we're pushing product hard. We're pushing the businesses to try to scale in. You're trying to look ahead to figure out, I don't have financial engineering to do anything. You really got to do market penetration, which is product engineering, really fundamentally, to drive the growth piece. And that's the growth aspects of the buyout. And then buyout, because we're typically doing, although we will look at minorities, everything to date has been control, but control, albeit with a strong role. Oftentimes the founders coming in and partnering with us love our understanding of how to navigate government profiles, how to build out sales teams, kind of scale product and engineering. And so they're coming to us and partnering with us because of those pieces. And that's the growth aspect, where we will do the control and the growth at the same time.
Is minority investing more a feature of growth? Because you don't see a lot of it in the LBO buyout world.
It's minority investing is more around what is the seller looking for? Do they want to do it themselves? And what's the versus do they want us to kind of really partner? Because take the VC model, right? It's all minorities, right? You'll have many VC checks come into a single round. Like they can't afford. Again, VCs do a great job trying to do network connectivity, helping the founders, but their mind share is split between 100 portfolio companies, right? They can't really dig in. It's that classic dichotomy that comes in, so for us, it's when we do, again, we're doing no more than one acquisition per year, right? Platform acquisition per year. We focus heavily on what can we do to support the business. We're spinning up, again, with the third business we just acquired, we're developing our own CXO program to try to create more resources, which for the companies and that focus, so they get the benefit of the focus and the concentration of our time to them, versus minorities the other way. You gotta do more minority checks and back out. You also don't have the control dynamic where you really need to pick and partner and let the founder cook, right? Kind of thing, versus the other way around.
So a growth story for you is less debt, more equity, probably a slightly higher valuation in the services world of, call it 5 to 8x in the lower middle market. And you're really underwriting the future and future growth and what are the levers that can be pulled to unlock value. Versus a buyout, it's a reasonable amount of debt, 2 to 3 times EBITDA typically in our space. You try to minimize the equity by having a pretty good entry point of 4 to 6x, right? And you're really underwriting the cash flow and the historicals of the business, and the unlocking of value is buying it right and then just keeping it stable, and maybe you have a few levers to create upside. And then as you talk about buyout growth, it really becomes a hybrid of the two. And so As you seek equity for such scenarios, is there a particular type of investor you're looking for that specifically understand that segment, or is it more about how you craft a narrative? And if so, how do you craft that narrative?
You mean like our LPs themselves that come into the deals?
Right.
It is. I mean, it's a lesson that kind of we learned kind of from the Interra story to today, which is it is a different type of investor. It's not it can be an EBITDA investor, and some of them are getting more, call it, growth curious, I would say. But early on, there was a very limited set that were looking at the kind of buyout growth dynamics. For us, it is heavy into, I would say narrative's in the right word, because it's not just spin. It is appreciating and diving into more of the what can this business be. And again, it's not so much a valuation conversation of trying to justify high valuation. Oftentimes we're not coming in and doing growth equity valuations. Oftentimes the businesses that we're partnering with have a lot of hands-on work that need to be done. And so we're willing to do that work. Again, Interra is the good example. Like, we rebuilt the entire tech stack from scratch, basically. And so it's really understanding and kind of having, when the LPs want to come into the journey with us, them appreciating where we see the vision for the business and having them, and that takes time for them to think through it, right? And I think so. I really appreciate the LPs that we're able to kind of grab a little bit of their attention. They're always seeing a ton of deals, right, come through, and they spend the time to think through, figure out what resonates, understand the TAM potential, see the dynamics that could potentially unfold, and then kind of want to kind of part with us. So it is more story driven in that sense, a little bit more like the VC dynamic is. But I would say, again, I'm biased. Obviously, I'm pitching our own book, but to us, we're trying to kind of get that PE risk profile with a little bit of 20% VC upside. And I think for us, that's the kind of balance we're trying to get. And I think that can work. That maybe that's our secret, but in the lower middle market, that can work, right? When you're doing $500 million deals, all the VC potential's kind of been wringed out of the business, right? There's no real pieces. You're more beholden to macro, and there's a lot more downside. So when you're doing large cap PE, you're really, really focusing hard on the risk profile of the business, what could go wrong. Because if it starts to move against you, you don't have as many moves. Versus here, like, again, going back to Interra, we rebuilt the company, right? And again, the core talent, the tribal knowledge was all there, but you can do a lot to move the needle on these smaller businesses. And that's what we've discovered. And so from our standpoint, that kind of PE risk, VC return is really around recognizing that you can have a powerful impact on these businesses and high flex upside. Not saying we get it every time, but you get that 10 to 20 to 30% chance that you really start to hit something and it works. And then all of a sudden you've got that outsized return that looks great. And it's fun for the team. You attract more talent. You can get more capital if you want it, and all that kind of comes together.
And so with your investments, it's not only about the maturity or the stage of the company, right, that you're discussing here, that they're growthy, but also in the EBITDA underwriting world. You also, in terms of gastronomy, the investors also have to have an appetite for, SaaS or government businesses or security businesses in your case. And so what are the nuances around that? Because these are not, you called industrials a catch-all bucket, but you're not really playing in that space, right? You're more specific about your industry.
Yeah, you bring up a good point, which is you don't think of government as growth, right? No one does. So, but I would say that I think particularly where the companies that we're partnering with and the scales, there's a lot of open TAM still ahead of them to do. As we start to get bigger, and again, we haven't hit this with any of them, we can move into more of I wouldn't call it a roll up, but judicious, M&A, where you can do highly complementary things. But the sales cycles, the equity expansion, there's a little bit of the multiple arb as you kind of upscale to more kind of traditional mid-market deals where the valuation multiples expand, and then proving out new adjacent TAMs and things like that, where, again, it goes back to the classic product management dynamic. They've got if they've got a core stable product offering with existing customer base, selling more to the existing guys, and then selling the same to new guys, and trying to kind of get those two to happen at the same time, which takes a lot of just talking to the customers, which is where we love to do. We love to get deep into the businesses, create more of the missionary mindset versus the mercenary mindset, But it's a lot of working with companies and very, very hands-on to do that.
But a lot of investors notoriously, for instance, will not touch restaurants or oil and gas. And
Yep.
You're kind of fencing yourself off a little bit too with your choice of industries, aren't you?
Yeah. I mean, I would say we would rather be specialists in the sectors that where we operate, as opposed to being generalists. I've always found, and maybe this goes back to my IB days a bit, where I talked to, I talked to a lot of mid-market sponsors, when I was doing investment banking, and a lot of them all kind of come out with, the pitch around what they do, value-added manufacturing and services. But after talking to, a couple hundred of them, it felt like I found a lot of them rhymed between them. There wasn't a lot of as much differentiation as they all thought. And again, I had the benefit of sitting at the IB seat where I am talking to lots of them, and they don't tend to talk to each other as much. But for us coming down here to the lower middle market, understanding, where your strengths are and where you can actually be differentiated, particularly as we go into call it the missionary mode, where you're really trying to sit down with the customers, take the engineers, out of their desk and go sit behind the customer at their desk and kind of watch them kind of realize and connect the dots around where the customers struggle with the product, and they come back excited. I mean, creating that inspiration, that dynamic is hard, but it's also fun because that's where the real innovation happens. It's at that last mile. The last mile is what really matters when you're trying to drive these things, and it's hard to be a generalist when you're doing that. That being said, I mean, and when we look at Emberline and scaling, there's a lot of echoes and near adjacents, right? When we start, healthcare, for example, has a lot of similarities from some of the longer sales cycles, buying cycles, and just kind of typical, I'd say, friction points that are in a lot of the A&D and the GovTech that we're doing right now. So as we look to expand, we'll probably end up vertical hopping a bit as we move into near adjacencies that have a lot of similarities.
And I imagine when you started out 5 years ago in 2021, being as specific as you are, right, to buyout growth for government security and SaaS.
Yeah.
I have to imagine it's easier today. There must be a compounding effect to deal sourcing, to investor networking, to value add opportunities within your portfolio. So how have you experienced that, starting so narrow, if you will, and how has that kind of evolved over the years?
It gets easier. That's probably, as any entrepreneur, the momentum begets momentum, and, cap raising for every deal got easier and easier. I think, again, there's market tailwinds in the indie sponsor market too. It's just developed more, right? I mean, the conferences have gotten more attended. The amount of people that I get ping me about, former, colleagues that are kind of, hey, what's this indie sponsor thing, right? When we started out, they used to say fundless sponsor, which was like a dirty word in a lot of IB. And now it's, the amount of people that I have had ping me or show up at conferences and trying to kind of get understanding what's going on here, it is no small thing. And that has definitely helped us a lot. But it goes back to, Nicholas, your point, which is you got to focus. There is a lot of opportunity if you're willing, if you look. When I get kind of, the virgin indie sponsors that come to me asking for a lot of questions, and I'd never really considered myself a veteran, but I guess at 3 companies, 3 portfolios, we're on our way. And the number one misstep I see for a new indie sponsor coming in is just trying to just buy something, and I think they will. That's going to get them in trouble. I understand there's a ton of pressure to want to get off the ground, get one on the board, get an acquisition, but the focus, dovetailing something with their specific background, what they're doing, what their experience, that builds confidence in the LP's eyes. It builds confidence for them post deal. I think there's also a lot of people that want to come in. Again, this was the lessons we learned hard, which is the operation, especially these size businesses, especially maybe also, again, with our flavoring of tech, can be challenging. You have to move fast in software, or any kind of growth investment, and you need to be very close. And so if you don't have at least a little bit of experience in the sector you're looking or wanting to play in, you can get yourself into trouble pretty quickly.
And is that how you guys arrived on your strategy of kind of growthy software? You were an engineer by training, right?
Yeah.
Chris, is that the reason for how the strategy, or was there something else?
Yeah, we fell into it. It was a little bit fortuitous, I would say. My partner and I came together, and it's a combination of the skill sets and where we do well. He had more of the operational background. I have much more than the transactional IB side of things. So our willingness to dive in again was, I think, combination of comfort doing the deals, with some of my industry experience, with his comfort of operating. And again, we are very hands-on if we need to be. I mean, our second transaction, he dropped in the CEO, which again, indie sponsors do, but we wanted to make sure, the sellers there wanted to move fast. They wanted out. They just want to retire. And so we're happy to drop in. Doing exec searches in these smaller businesses can be tough sometimes. And number two, we wanted to make sure we felt if we ever, prove to us, ourselves, and the LPs that if we need to run the business, we'll do what it takes, right? And so, and three, I think there are the unintended benefits of realizing all the things that come with running these businesses that when you're sitting on the board, you don't see. And it's changed our, thinking substantially. Everything from, we're kicking around John, my partner, and I are kicking around the ideas of hiring an applied AI engineer, right? That would almost drift across the portfolio because there's so many places where you can just poke and prod and kind of uplift some things, I think, or different ways you shift go to market, depending on the ACVs and check sizes for the businesses that just happen when you're in the thick of it. And, I've always idealized the investors that could be an operator and think like an operator and think like an investor at the same time. When I saw in my IB days, the smartest transactions were the people that really were formerly an operator that turned investor or vice versa. And so you see that it really unlocks a lot. The 1 + 1 = 3.
Tell me more about this AI or applied AI engineer you're contemplating.
Sure. I mean, it's not our idea, but it is something we're looking at closely. All the dynamics around what it takes to investing in. And again, this isn't software specific too, by the way. This is any business, particularly probably you could argue more for service businesses, but the pace of innovation around what you can do with AI is so fast that we are trying to figure out how to stay ahead of it. And again, you can get too fast too, by the way. Like a lot of people started rolling their own models and code, 12 months ago, realizing that the core LLMs just passed them and it was a waste of time because you didn't need to. So, but for us, it's as much trying to learn as it is culture adoption, as it is just trying to drive value. The impetus here really is everywhere across your business, whether it's in the go-to-market side, in the CS support side, or in the back, the engineering side, could benefit from more using AI tooling and understanding the latest techniques and tactics. It's not building our own models. It's taking what's out there and understanding how to develop it. Because we see this with the engineers a lot. It changes how you do engineering, software development, and it's a change that sometimes engineers don't really want to do because they don't really like the new job to some extent. Engineering, coding is changing. You're more about managing agents than you are about, managing code. And that's not a lot of, it's not fun. I mean, it's a little bit, the finance equivalent would be, you're managing people that make models instead of making the models yourself. And there's a difference there. And you also lose connectivity. You lose appreciation for the nuances that drive the changes through the model, is staying on the analogy, when you're not doing it yourself. And so it creates a little bit of a tension that you have to try to figure out. And when you're going into more lean forward, growthy businesses, we're trying to find that balance between not blowing up what's working. We're doing, again, going back to Interra, that is software for that is highly utilized in disasters, right? It can't go down. You can't just throw AI at it and see what happens, right? So you have to be very careful. At the same time, go to market there, for example, like, are there other things you can do to, help pre-write scripting, scrape, understanding leads, prepping the AEs before the call, so they don't have to carve out 20, 30 minutes before, that they needed to on prep, right? So it's applied AI in that sense. And we're trying there are no experts here. Like, this is moving so fast that we want to just, we want to make sure we stay a part of it.
How would you think about compensation for a good candidate like that, realistically?
I would be around, it'll be, as any of our roles, it's outcome oriented. It would be someone that gets to drift between the portfolios. They have to either be an engineer that understands kind of business operations, or someone that's more from the business side of things. It's very tech savvy, right? It's a very odd role, to be honest. It's not something that exists, at least I've seen, other than some of the larger VC backed businesses have things like this. So compensation would be very much outcome oriented, maybe equity if they're senior enough. Probably definitely start with, base engineering type salary and probably move up from there. But it's also a unique role because you get to do lots of things and stay at the leading edge of what AI is doing.
Oh, absolutely. But a pretty highly paid key person on the team here. And you've seen private equity, you mentioned VC also, they can hire centralized resources for marketing, HR, accounting, or sales, or legal. But I hadn't quite heard about it in the independent sponsor world, at least, someone who's specifically focused on AI. So that was interesting.
Yeah.
At what point do you think an independent sponsor should or could consider centralized resources, regardless of which branch it is in the back office? At which point is it when you have 3 deals like you do, or at what point can they afford that?
Yeah, I mean, it's let me think through that. It's been a ongoing evolution for us because, and it's again at the 3 deal mark now as we're starting to entertain it. So maybe that is the good, again, N of 1 here for us, but that might be the good way to think through it. We're kicking up our CXO program too. We've got, 3 individuals coming in to help support us. And then we're looking at driving resources like this applied engineer role. And again, this is something we're just contemplating across the portfolio where you need to give them enough projects across the team across the companies to do that, right? Yeah, and also create a little bit of a repeatable engine. It's not unlike doing a roll up too, where you tend to standardize the way you ingest, the kind of smaller, similar type businesses, where you have to kind of standardize. You tend to have dedicated integration teams that you have to keep feeding the integration teams with the next roll up, right? There's some similarities here where you need to give. You have to have done enough work, right? If you have 3 different go-to-market, I would say buckets across 3 different portfolios, that's enough of a kind of swath of testing and experimentation that you can benefit from trying different things, stuff like that. But yeah, you've seen the market's moving so fast on the AI side that it's hard to even keep up.
Have you at all looked around for the existence of such a person? I'm reminded of whenever a technology is new, it's like when they said back in the 2012, 2013 days, trying to hire a mobile engineer.
Yeah.
And an experienced mobile engineer had been at it for 12 months. It's like there isn't experience yet because this is all moving so quickly and it's so young. And so it just makes it that much harder. So you're paying up for somebody who just started a year and a half ago. I mean, the prices rise, and yet the actual time in market is like going down because nobody has any time in this market.
I would actually say I'm more inclined to find somebody like in a current engineering role, for example, that is just interested in a different role. Same thing with a lot of the hires that we found, finding more about personality and interested in us and the mission of the company. And, I can teach them a lot of the more foundational things. So for me, it's an engineer that actually has always been really interested about go-to-market, right? Or the customer support, but they understand kind of the nuances and personalities of different LLMs and can kind of explain that to the CS team who's not playing with the different models out there and understanding it. And so I don't necessarily think it's an expensive person. I think the expense is on our time to build that because this role doesn't exist. And then, making sure you find somebody that's got the right personality fit too for the role. It's more of a unicorn role for sure.
Mm-hmm.
Yeah. Because there's just like your mobile example, it doesn't exist right now. Yeah.
Well, speaking of roles, Chris, let's close with just a quick conversation on the CXO program that you mentioned in passing. Can we double click on that? What are you envisioning there or building?
We're again because of I'd say the investment style and MO we've drifted into is very much, again, going back to the building that missionary mindset within the companies themselves, trying to really get deep into what are the customers doing, how are they, how are their challenges solvable with our engineering teams and our product teams and our go-to-market teams. It takes a lot of commitment and mind share from the teams to kind of go in and integrate with the customers that level. And what we found here is John and I love what we're doing. It's fun, but it's not scalable between the two of us. And we saw that, pretty quickly. And so part of this is an experiment, but I would also say it's a pretty unique opportunity for individuals that are interested, where we've got 3 individuals coming in right now as we speak, since we just closed our third deal, that will be spread across the portfolio, and they get to basically start to embrace some of the kind of lessons and learnings and stage growth that we've learned over the last several years. And again, from my view, it's an exciting role. I kind of wish something I would have had earlier in my career. They can kind of choose their own adventure. If they want to eventually keep doing more deals, because some people tend to love more project-oriented work. If they want to eventually pivot to a CEO track, it's a great precursor to a CEO track. If they eventually want to go up to an operating partner, investment partner role, that's also potential. So it's, or maybe they just don't like it. But that, from our standpoint, it's fun because you're going to need a lot of responsibility very quickly to come in and help us try to scale what John and I are doing.
And are you modeling this program off of some of the better known ones in the market?
Oh yeah, I mean we're not the originators. I mean, I'd say Alpine does a little bit like this. ShoreCap does something like this. I mean, we're putting our own stamp on it for sure. But it's a known problem, and we're really excited to be able to craft this for our kind of lower middle market bio growth piece. Mm-hmm. To kind of make it scalable. So, I mean, hopefully, if you have me back on in a year or two, we can look back and see a bigger pool of candidates, and some more portfolios that we get to kind of teach and grow the team across.
Great, Chris. Well, it's a date. We appreciate you. We appreciate you coming on today and sharing with us what you built so far. Really great to get a perspective on B2B software, how AI is changing it. This is, of course, in all of our news feeds all the time, but rare that I get to pick the brain of a practitioner. So really appreciate your insights and your time.
Yeah, well, thank you, Will. Thank you, Nicholas. Thank you for having me on. It was great to be here.
Hope you enjoyed that interview. For more like it, subscribe to the Minds Capital podcast wherever you listen to podcasts. You can also watch us on YouTube. Also check out Minds Capital, where Nicholas and I are partners alongside Max Lummis. We invest equity in independent sponsored deals. So if you're a sponsor with a deal under LOI, please visit mindscapital.co to start a conversation. There's also an investor tab on our website with information about future fundraises. See you in the next episode.